Okay, so I'm going to show you exactly why I only use one time frame. Now, before I get into this, I just want to preface that multiple time frames work for different people. For example, you should not be using this time frame if you're a swing trader, and vice versa if you're a scalper. But if you're an intraday trader, this time frame I think is the best one, and I'm going to explain exactly why I think that is the case. So, in my opinion, and I've tested, the hour, the 30-minute, even as low as the 5-minute. In my opinion, the best time frame to use is the 15-minute, and I'm going to explain exactly why. For intraday specific trading, the 15-minute is the best time frame, and I'm also going to talk a bit around why the one time frame method is great and why the 15-minute works great for that. So let's get into why the 15-minute time frame and why one time frame and why this is the best one for it. So firstly is overall direction. So when we're intraday trading, you don't typically need to be looking at the wider trend, because you're only going to be in the trade for maybe say a couple of hours, but it's still good to have an idea of. Now, normally I see a lot of people start on kind of the 4-hour, get their direction from that, then drop down to the 1 hour, and then the 30-minute, and then so on and so forth. The 15-minute kind of shows all of that in one go. For example, if you just zoom out like this, you can see that over time since the end of Feb, we've been trending downwards, and that's great because it essentially shows you, and you can go along and you can see that from as far back as the 27th of Jan, we've been in a very long-term downtrend, right? So overall bias for market movement is kind of visible just by zooming out. But then you can zoom in and say you wanted to look at how the the previous day was. Well, you can see that we were actually pretty sideways. If I draw across like this, you can see that since Thursday we've kind of been bouncing in between and consolidating, and now only just have we broken out, come back in to retest to probably go further to the upside. So again, you can see both the overall trend since the last kind of month, 2 months, but you can also see the last day, or you can look at the last week, and even still, if you zoom out, you can kind of see, bar this bit of PA here, that we've been in a very consolidation. We've been in a very consolidation kind of area since the kind of first test on the 30th of March. Now you can see that we're probably in some sort of accumulation stage before distributing higher, and so that's why the 15-minute is great. Not only does it show you the long-term time frame for intraday, but it also could show you the day or the week still pretty clearly. Now, that is very similar obviously for the 30-minute and the hour. The difference being is you can also zoom in more, which you can't really do on, say, the hour. Now, say for example, you wanted to, I don't know, get in a buy down here or get in a sell up here. If you go to say the hour, it becomes a lot harder to get entries. So with the 15-minute, you can see a lot more candles, right? You can see 4 candles within 1 hourly candle, or you can see 2 in 1 30-minute. So not only does it give you that overall view, but it also gives you the ease to kind of scale down a bit and get better entries. But you don't want to go too far, because then you get caught in a lot of noise. So when you start going down to like the 5-minute, you could start seeing things like, fake breaks of structure, like that. And then look, you get a break to the high, which could then be confusing. So the 15-minute is the perfect, I guess, balance between being zoomed in enough to get entries, but also zoomed out enough to kind of get that correct sort of overall market trend. As I said, if you zoom out, you can see that we've been in that kind of sideways momentum, and now we've broken to the upside. So that's why I really, really like it, because As I said, it combines both the higher and lower time frame benefits into one. Now, of course, make sure to backtest this and actually see which one has the higher win rate. But for me, the 15-minute is perfect for this situation. Now, the other thing, and the reason why I think this, having this one time frame is great, is because you kind of get it all in one spot without getting any kind of bias or directional bias that may confuse you. And what I mean by that is some people that use, say, the 4 hour for their directional bias, they're going to see that we've broken to the upside, and so we're going to be looking for buys if you were looking on the kind of the 4 hour. But if you drop to the 15, what's happened? Well, we've broken to the downside, so the chances are we're going to be looking for sells. And so you end up in this weird situation where you're looking for both buys and sells depending on different time frames. Whereas if you just zoom out, you can see that sure, we broke into the upside, but the high we broke was a long time ago. It was on Friday and now it's Monday. So is it as strong and as relevant as it needs to be? And so you might lean towards sells. Now, this isn't always going to be the case, but I'm just pointing out that sometimes when you use different time frames, you can kind of get confused between what is a sort of correct move to go with. Do you go with the higher? Do you go with the lower? Definitely always go with the higher most of the time, just because that's the more valid one. But if you just keep it on one time frame, you can follow the direction a lot easier while maintaining the level of detail you need for like a better entry, which is, as I said, why I like the 15-minute, because you get that. You get the ability to see the overall trend, as I said, over the last few months, but also what price is doing in the last sort of few days to week. And then you can scale right down and you can look for entries. So that's kind of why I think the 15-minute is perfect. Now, why, and I've kind of touched on it a bit, do I think you should just use the 15-minute or just use one time frame, depending on whatever one's stronger, is, as I said, so you don't confuse yourself, but also it makes your testing far easier because you're not having to change time frames and scale down to different zones and accidentally skip forward or go back. So not only does it make your testing easier, but it makes your overall bias easier as well. So those are kind of the reasons why I think the 15-minute is the perfect time frame to use, and also why you should only be using one time frame. Now, again, this is for intraday traders, not swing traders, but I think the principle still stands with swing traders that if, for example, you're on the 4 hour, just stay on the 4 hour. Don't use the weekly. Don't go down for entries. Just trade based off what you're seeing on that one time frame to avoid any confusion. Now, the one caveat to this is I think some pairs, like for example gold, are a little bit different to kind of the rest of them. The reason being is they're a lot more volatile. They change direction a lot more. And so maybe using multiple time frames on gold would make more sense. For example, with gold, you need fairly big stop losses, especially with the kind of momentum it has. So for example, this is over 200 pips. So maybe there could be a way of dropping down to like the 1 minute, finding a better SL, and then you can kind of tailor that to bring that down. So more volatile pairs like gold, maybe using multiple time frames would make more sense, but I don't really trade gold. I just stick to GU, and I think that GU, using one time frame, for me specifically the 15-minute, but just using one of your choice, is by far the most optimal way to trade. So hopefully you found that useful. Let me know, do you use 1 or 2 time frames? Do you do top down, or do you just keep it at one? Let me know what you do, and I will see you in the next one.